what the DTI is going to say is actually, Andy, no, you can only lend 600,000 now because that's the DTI calculation. We're not going to give you too much money just in case this happens again. Is that a fair example?
Bang on. And a good way I like to look at it as well is when I talk to clients, there's three main things the bank looks at when you're looking to lend money. They want to know you have the equity, and for a first home buyer, that's your deposit, right? And so that's one thing, the LVR, loan to value ratio. Then you're servicing. Can you actually service this within that test bracket range as well? And the final thing is account conduct.
Yeah.
Like, have you been paying your bills? Are you a good client of the bank?
Hello and welcome back to the Homeseekers podcast, the essential guide for navigating New Zealand property market with confidence and ease. I'm Andy, your host, and whether you're a first home buyer or looking to add another gem to your property investment portfolio, today's episode is crafted for you. The market is ever changing, and as humans, we've kind of learned how to adapt when we need to. So it's fairly safe to say, if you one that adapts quicker, you can revel in the rewards that follow from that. Now, I'm with my co-host, more or less co-host now, Simon, mortgage advisor at Mortgage HQ, our sister company, and he's here to run through a few of the changes that sort of happened since the last time we got together and did one of these episodes. So since then, we've had a lot of change, right? We've had first home buyer grants being scrapped. We've had interest rate easing. We've had banking changes and how that could affect serviceability or how much lending that you can take. We've had interest deductibility being scaled back for investment properties, as well as bright line test changes. So a lot for us to actually roll through with today. And I just want to grab your thoughts on all of what's going on in the market and sort of give the people listening as much information as possible to help them make a little bit more of an informed decision, or at least just to bring them back up to date with what's going on, right? So with that being said, shall we just get into it?
Yeah, absolutely.
Awesome. So first home buyer grants, let's start there. It was a talk of the town, really has affected people who are wanting to get into the property market for the first time and might be limited with their deposit, right? So the government have more or less just removed some initiatives in which they had available to your first home buyer and what that might look like. So do you want to just run through what the first home buyer grant was and why do you think it was scrapped?
The first home buyer grant was essentially free money that was provided. Everyone likes a bit of free money. The government was providing this incentive for first home buyers. It was scaled from $5,000 for existing homes up to $10,000 for new builds.
Per person.
And if you're a couple, you got an extra $10,000 or $20,000 towards your first purchase, which is, it's a lot of money. And these people were using it to purchase their first homes. You asked why was it scrapped?
Well, yeah.
I have my theories, but I think one which is quite obvious is the fact that the new government has made a lot of promises. And a lot of those promises come with a price tag. And so they're going to have to balance the books somehow. And this is one of those easy, low-lying fruit. And saying that, it was probably a politically hard thing to do, right? They want to be seen as someone who's helping the first home buyers, but they're scrapping this initiative. So I think they've pivoted it a little bit and allowed some more investment elsewhere.
Yeah, so it is certainly going to help. It's going to hurt people, right? We've already seen it with clients that we've been dealing with and, their deadlines and how they have to make decisions if they want to keep that. Now, other than the first home buyer grant, what should people do instead? What's still available?
Yeah, there are several options. One of those is that you can essentially go, if you're wanting to enter the market sooner rather than later, you can enter the market at a lower deposit. And there are options there. And we've covered this in a lot more detail in some of our other podcasts. That's one. The other one is like the bank of mum and dad. That's never going away. For some people, they don't have that option, but some do have that privilege. And sometimes it's a matter of getting your advisor involved in explaining what options the family have, whether it ranges from a gift to a deed of acknowledgement of debt, which essentially guarantees the person who's gifting that money that they'll get it back if you sell the property at the end. And so that gives a little bit more confidence for friends and family members that are providing people a hand up in these initial circumstances. There are also the first home loans, equity loans that are provided by Kāinga Ora.
Yeah.
So these still are available. They're not my favourite, to be
Yeah.
completely honest. It would be my last thing that I would look into.
But if you need to, you need to.
100%. And that's what the initiative is there for,
Yeah.
is to allow that. There are other more creative ways, like you could go into a property that's undervalued that you purchase, building that equity with a low deposit, and then making that equity and then refinancing when you're at 20%.
Yeah, there's definitely still opportunity out there. It's not all doom and gloom, right? And some of the conversations that we've had with clients is all about pivoting, right? Like it's all about making those proactive changes opposed to just sitting on your bum and not doing anything and thinking, oh, this is really, this is hard on me. Why did this happen to me? Having that mindset that we've also talked about, like that winner's mindset we've talked about many times before. But it's interesting because the conversation I have had from time to time is pivoted into, okay, well, I actually have surplus income. Should I be pushing my KiwiSaver to 10%, for example, to boost up my deposit because I've lost $10,000? Well, never lost it because it was never yours to begin with, but people are starting to think that way, and that's encouraging because we want to see people make proactive decisions to help them get there opposed to feel sorry for themselves. So being a little bit more creative, as you sort of said. But whilst we talk about the doom and gloom and perceived doom and gloom with this being removed, we now have a little bit of interest rate easing, right? Is that fair to say? Is that what you kind of see?
Yeah, last 6+ months we've seen interest rates come down, in some cases by 0.5%. So we were 7.4% ASB was at the peak, right? And that was really the peak, end of last year, in relation to interest rates. But now we're seeing things like 6.6, 6.62, that kind of thing on a 1 in 18 months.
Obviously
like
depending. But
it's a special rate you have to negotiate.
Yeah.
Talk to your broker.
Because I have seen, interestingly, like the long-term rates, the 2 years, mainly 3 years, 4 years, and 5. I've seen a bit more shift in those over the 1 years. Now, I've got my own opinion as to why the banks do that. You'll probably have a lot more insight as to why the banks do that. But if we start to see those 3, 4, and 5 years coming down, is that an indication that they also feel the market's starting to slowly strengthen and they're feeling more comfortable to lend money out a little bit cheaper for longer?
Well, it depends on what you mean by the market, but essentially the market for lending for the banks. But yeah, it all depends, I think, much more heavily on overseas funding.
Yeah.
Which there can be a disconnect between, look at domestic inflation, for example. Domestic inflation is super sticky, and we've got all these other countries getting it better. The inflation is coming down a little bit faster than we are doing here in New Zealand. So we can have a disconnect between our local economy and its market with regards to property and business and things like this, and the swap rates from overseas funding. And what that makes a difference in what you see on your interest rate.
Yeah, of course. And that is a key factor, right? It's not just about what's happening here in New Zealand, it's actually what's sort of happening worldwide, and that's what dictates 100%. A lot of the interest rates there. Now, are you seeing banks a little bit more competitive against each other now when it comes to maybe cashback entitlements, when it comes down to negotiation of rates? Are they trying to win the business more aggressively than what they might have been, say, 6 months ago, or is it fairly the same? What do you reckon?
It's hard to say. Some players, like sometimes I'll be negotiating for one client, sometimes I'll be negotiating for a different client at the same bank, and there's different deals and similar makeup. So it's very hard. Yeah, they may have different risk profiles, but ultimately what I'm seeing, if I want to be specific, I've seen one particular bank, and I won't name it, but who's not traditionally provided retention cash.
Yep.
Now provide retention cash.
So that's the providing clients with money to stay opposed to move. Right. Normally it's only new banks that give you money to join them. It's not often banks come out with retention cash. Now I do know one top of my mind that has done it quite aggressively in the past, but now you're saying there's more than one player.
Yeah, I would say there have been several players that have, to a degree, done more or less retention cash throughout the time. But this one that's in particular that I'm thinking about has traditionally never really done retention cash.
Okay.
They provide great offers elsewhere, on the front end and things. So to have these guys offer my client retention, it's a beautiful thing for my clients. So
of course.
I'm glad we got to do that, but I was very surprised.
Yeah, I can imagine if it's not quite normal for them. Right now, we talked about just multiple banks there. How important is it to have maybe more than a relationship with more than one bank? Split banking, maybe husband, wife, partners, or even yourself having, like, I know myself, I'm a main bank customer at more than one bank. That's just how it's worked out. Do you think there's advantages there?
Yes and no. So I'll start with the yes. So the yes is, for example, if you're working with your financial advisor to buy your first home, right, and there's this lender that provides preferential treatment for first home buyer, but they have to be a main client of that bank, then it might be advised as a plan to open an account and put your incomes into that bank and be with them for 3+ months, say, before applying for a mortgage through them. That may be a strategy that works for you. On the other spectrum, where it might not be as good, but I'll play around with this, there is a good and bad. A lot of people talk about the split banking, right? And you know what I'm talking about.
Yes,
with this.
Of course.
For viewers out there that don't know what that means, it's essentially if you've got multiple properties, for example, and instead of having all your properties at one bank with all your lending at one bank, you would have one property at one bank with some of the lending there and another property at a different bank with some lending there. Now, the benefits of that, in my opinion, the majority of the benefits come when you go to reduce your portfolio size, when your income's reducing at the end of your property journey, right? And so the reason for that is because they will essentially test you again on what income is left over if you're not split bank and force you to repay some of the money that you were hoping to hold on to as debt that you saw as cash flowing to release equity for other purposes. Now, that's not the case when you're building. When you're getting more and more income every year, and let's just say that the servicing test rates stay the same, then you may be much more advantaged to be at one bank. And the reason why is because of this. If you had a total lending of $1 million and you had 500,000 at one bank, 250 at another, and 250 at another, then those small loans, especially the under 500K loans, you're not going to get a very good service. Like they're not going to negotiate hard with you. They're not going to give you good rates, decent cash, especially if you're wanting to push that little extra amount out of them. But if you combined everything at $1 million loan, banks are much more willing to negotiate for you now. They want to hold on to you. That loan is a decent size, and they would be much more likely to provide that extra point off the interest rate.
Because I do recall a few, would have been last year, I think. Maybe it could have been even the year before when we, were helping first-time buyers through their journey at that point in time. And one of the situations we found ourselves in were policies were changing relatively quickly, every 3 to 6 months with what certain banks were allowing for first-time buyers and what they weren't. They had an allocation. Once it was gone, right? So at that point in time, we were talking to clients about, okay, have your main your main relationship with more than one bank with income split banking so that you've got access to maybe 2 or 3 sort of, in case the policies do change, banks. Is that still the case, or is it not as much anymore?
Yeah, I had a couple that was first home buyer. One of them was with one bank, the other one was with the other, and it just so happened that just because that person was a main banking at that other bank, they got the preferential treatment.
Right.
So they got to purchase this property with a much better deal than the other bank would have provided because of the fact that they were existing clients.
So there most certainly is a benefit of split banking and making sure that you're with one of those that actually got a good appetite for first-time buyers.
And that's where coming in and speaking and having a plan prior to moving into some of these things with an advisor to say, hey, look, these are our strengths, these are our weaknesses. What is the bank that's currently providing the best options for us, and how can we move into the direction to utilize it?
Because I guess, again, every bank has different calculations, right? And servicing calculations is one of those. And it's a great segment into moving into this word DTI, or the abbreviation of DTI that we've heard plastered across the news over the last couple of months, how there's going to be changes, or there are changes being made. Right now, there's debt to income calculations and the serviceability calculations, which is what we've been used to in the past. Just break it down.
Cool. Easy. So servicing or servicing test rates is a rate that's applied to the debt that you're taking out and or any residual debt to ensure that if you take on this debt now at a certain interest rates, that if they go up, that you can still service it within that band, right? This essentially stress tests your ability to lend during higher interest rates. Now, there is a margin there, like it's usually about 1.5% to 2.5%.
So what that means is
current
if the interest rates are 6%, you're going to be stress tested on maybe 8.
Yeah. And if they're 6.5, maybe 8.5, closer to 9. At the moment, interest rates are 6.6, something like that on some of the lending, 6.8 on a 1 year, and so test rates are around the 8.8 mark.
Yep.
So what I would say is that's servicing test rates, and that's what's stopping people right now, right? And that's why DTI, even though it's coming in, it's actually not an issue for any of my clients. I've run several different scenarios whereby every single time it's a servicing test rate that stops you. The debt to income doesn't even come into a factor. However, why have they brought it in? I'll tell you why. When the economy and the interest rates, when the economy was running hot, when interest rates were really low, I think we're picking something up at like 2.15 at the lowest, 2.15% on a 1 year rate. And so what that meant is that the servicing test rate was down there, the 4.5% mark. And so suddenly you can afford a whole heck of a lot of debt.
Yeah.
And so the banks were piling it out and allowing it and lending it out. And that's what probably fueled a lot of the inflation as well and the problems. And so in that circumstance, the debt to income becomes a much more effective tool
to protect people, right?
For the Reserve Bank to say, hey, look, we're gonna slightly increase this or lower it depending on their risks, where they see the risks in the economy. So you may be able to afford it, including the buffer, but the bank's like, sorry, we're in a historically low period of interest rates compared to where we think long-term interest rates are going to be, and I know you're testing them at on 2% higher. But what happens if they return to their mean, which is 4% higher? And so that's when the debt-to-income ratio or policy becomes much more effective for the Reserve Bank to control these risks in the economy.
It can be looked at as a tool to protect people, right, from getting into potential mortgagee sales down the track when we see massive shifts like we've recently seen. So correct me if this example is correct. If I've got say $100,000 income on a DTI of 6 times, I can service $600,000 worth of debt, right? For argument's sake, maximum amount of debt against my name.
Under the DTI, not
under the DTI, right? Yeah. Now, let's just say it's 2.1% interest rates, but the bank's actually telling me I can borrow $800,000, for example. What the DTI is going to say is, actually, Andy, no, you can only lend $600,000 now because that's the DTI calculation. We're not going to give you too much money just in case this happens again. Is that a fair example?
Bang on. And in a good way I like to look at it as well is when I talk to clients, there's three main things the bank looks at when you're looking to lend money. They want to know you have the equity, and for first home buyer, that's your deposit, right? And so that's one thing, the LVR, loan to value ratio. Then you're servicing. Can you actually service this within that test bracket range as well? And the final thing is account conduct. Like, have you been paying your bills? Are you a good client for the bank? That kind of thing.
Yeah, we're not talking about how they went crazy years ago and just about you can't have avocado and toast. Not a thing really, right? It's just the generalized conduct of a particular person.
Yeah. Do you pay your credit cards back?
Yep.
Do you pay your loans back on time? That kind of thing.
So ultimately, for first-time buyers, this whole introduction of DTI isn't really going to affect them at all.
Not in this current market.
Yep.
Until we get back to those times where interest rates are lower and that's a perceived risk for the Reserve Bank to start reining in. That's now they've got that tool in their toolbox, because at the time they didn't have that tool. It wasn't provided. It wasn't one of those things that they could pull in terms of a lever. Yeah. But now they're there. So I think they've done it retrospectively, and they could have had that tool during that time period and maybe saved a lot of heartache during this time. But now it's there, so that if we return to a low interest rate, they will utilize that tool at that point.
In summary, not really going to affect first-time buyers. If anything, it's a protective tool if it ever needs to be used. Simple as that.
Correct.
Now, another aspect that we've talked about internally a lot is interest deductibility and how that's been scaled back for those who have or are looking for an investment property. So it could be your first one, you might have multiple investment properties, but the interest deductibility is an initiative that's been reintroduced, right? Not necessarily reintroduced, but just changed. So again, I said break it down because we've talked about it and it's better coming from you than it is from me. So explain exactly what interest deductibility is where it was maybe a year ago and what changes have been made?
A big disclaimer: I'm not an accountant. I do dabble with the stuff with my own investment portfolio, and there's a lot of conversations I have with the accountants we refer our clients on to,
The one we've got in-house, yeah.
and the one we've got in house as well. So, in simple terms, you own an investment property, and essentially it's like running a business, right? You have certain expenses that you have to pay, and you've got income. The income comes in, and for an investment property, it's rent, right? So the rent comes in, let's call it $1,000 a week, and then you have expenses of, let's just say, $500 a week, and that's, say, interest that you have to pay towards the lending that you use to purchase the property. And then you've got another $100 a week from other expenses, rates, insurance, repairs and maintenance, those types of things, management fees. And so the tax that you would be paying on that is the $400, the leftover, right? So you've got $600 worth of expenses, $1,000 rent, you'd pay tax on $400, right? Because that's the bottom line. Now, in the case, what happened was they removed deductibility, interest deductibility from the equation. Therefore, that $500 of interest per week that you were paying, that was a real expense, was no longer allowed to be used as a deductible expense. Therefore, when you went to pay your taxes, you would be paying taxes on $900 as opposed to the $400. And so the way I saw that is just incredibly unfair and unorthodox. Like, it's just so far out of the norm in relation to what the fundamentals of how I understood how you run a business, you know? And so...
Because it's a real expense.
It's a real expense, and I just don't understand it. So I don't understand how that was ever justified by any means.
But it was.
Yeah.
And now we have a change.
Exactly.
And that change effectively, as you said, that's being reintroduced, but at a scaled model, right? So you can't automatically just wipe off all interest that you're paying, right? It is a scaled model.
Yeah, it depends. Look, the exact dates and times of when you purchased and if you're purchasing now moving forward, I'm not going to be able to rattle off the top of my head. Quick Google will tell you. But essentially, if you're buying, I think it's next year, July, or maybe it's April, I can't remember exactly, you're going to be back at 100%.
Yeah.
So I think currently we're at 75 or something like that.
So
don't fact check me on that.
But ultimately what we're saying is that moving into investments now from where it was prior might be a little bit easier for cash flow, right? Because before
100%.
we would have been in a position where you're getting $54,000 of income in that sort of example, and you're paying tax on a lot of that income, even though you're not seeing it in your back pocket, right? So you're getting taxed, and there's big bills coming through. So do you think that's going to accelerate the investment market?
I think it's going to level the playing field a little bit between the existing properties and new builds, because essentially what it was it is an unfair advantage it was an advantage for new builds.
Yeah, because they had different rules to an existing.
I felt like every client that was coming through was saying to me, I want to buy a new build because I've got interest deductibility.
Yeah.
And then we ran the numbers and we said, even with the interest deductibility, you're still going to be worse cash flow.
Yeah.
So it was about educating them on just because you don't get the deductibility doesn't mean that it's still going to be a better investment long term. So, it's just a matter of understanding the numbers, how to run a cash flow calculation, of which we provide for free at Mortgage HQ. And, so understanding those numbers, working with a professional to do so.
Yeah, because I think where I say do we see ourselves having an accelerated market with the investment, I think is also off the back of the changes with Brightline, right? The tax you have to pay on an investment property if you sell it within a set period of time. Now, there's been changes there as well. So do you think because of those changes and because of where interest rates are and a lot of the pain people have been going through, that we might see an influx of properties hitting the market the minute the Brightline test is rolled back and changed, and thus accelerating the investment market for people to get in? Do you think that's a real thing that would happen?
I'm 99.99% sure that it has rolled back. It's 1st of July, I think it was.
Yeah, 1st of July.
So I'm just going to repeat what I hear from the guys that are on the ground, which is the real estate agents. And I speak to quite a lot of them. And they are all telling me that there's a glut with these types of properties, especially the new builds, where people can't hold on to them anymore. Negative cash flow, severely negative cash flow, and a lot of them are making a loss to sell it, to get it off their books. And some are in better positions to do so than others, and it's if you have to sell now, man, I feel sorry for you.
Yeah.
But in some cases, you don't really have a choice.
No.
And so, I definitely think that people, now that they're outside the bright line, will be considering it. But if they're making a loss, they're not going to be paying tax anyway.
No.
So
They're just going to be losing cash.
Yeah, I remember speaking to this one client. They're like, "Oh, we're going to wait until July 1st until we're outside bright line." And I said, "Why?" They said, "Oh, because we won't have to pay tax." And I was like, "You ain't got no tax to pay. Like you're making a loss on this."
Yeah.
And it dawned on them, that actually that doesn't make any effect at all.
Yeah.
But definitely a lot of people were talking about selling it.
Yeah, because
some of them held it for many years, right, and wanting to sell, because an existing home was 10 years.
Yes.
Right?
Yeah.
So you could have held a property for 5-6 years thinking, I can't wait until this 10-year thing comes up. And suddenly you're 3 years ahead of your goal of wanting to liquidate and move on with your life.
Yeah. So
I do think there is going to be a glut.
It used to be the bright line was more or less you've got an existing property, right? When you buy it, if you sell that property within 10 years and it's not your owner occupied, it's an investment property, you've got tax that you'll have to pay if you sell it for a profit within that 10 years. That's what it was.
For an existing
property, investment property. Now, again, that not your owner occupied, but if you turned your owner occupied because you want to go say you want to go overseas for 2 years and you want to rent it out, it now becomes an investment property and all of a sudden you're in that 10-year bright line test, right? Which again is incredibly unfair. But what the bright line wind back has done is it says, look, if you own property, you have to hold on for a period of 2 years now before you make. If you sell within there, you are paying tax. If you don't and you hold it for 2 years, you're not paying any tax on any profits. That's sort of what's happened, right?
Yeah,
In
it's
summary.
really important to understand here that we're just talking about bright line tests.
Yes.
There's several other,
Of course,
little hooks that could get you. So definitely consult your accountant before selling a property.
Yeah, so it also gives investors a little bit more options moving forward. If they want to purchase property now, the intention is maybe holding on to it for a long period of time, but if circumstances change and they're out of your control, you're not now being hindered any further, right? Now, with all of this, one question that was put to me by a client, and it was something I was going to mention at the very beginning, completely forgot, but this is all about, first off, the CV value versus rateable value I want to talk about. And I also want to talk about the OCR for a second, okay? But when it comes down to the CV, the council valuations that everybody sees on Trade Me, when they're searching for property, it's always off the CV, the council valuation, right? Not what we call the registered valuation, the RV. I'm throwing it in the mix because of that reason. When you are searching for properties, that's a big part of it. Does it really matter? Like, does the CV really matter other than what you have to pay your rates on? But when it comes to looking at properties, purchasing properties, is that is that gospel? Is that figure a realistic sort of valuation of that property in your opinion?
I think I would like to see some stats on this.
Okay.
Because I remember seeing this big long list, and I see it a lot in sales comparisons, right? And then I look at the CV versus sale price. I'm like, okay, this one's 100,000 over the CV. This one's 100,000 under. And I'm trying to find out what the data is that's trying to pin down what the CV is. And I've never really seen any correlation. So I would like to see if there's...
I've got some data
for you. Oh, you do? Oh, great.
Yeah, so it's interesting. I'll look at some kind of major, just some centres here. So Hawke's Bay, right, selling over the last 12 months, I have to say, over the last 12 months, that is minus 11%. So 11% below CV is what properties are selling for. Okay, whereas somewhere like... In general. Ashburton, for example, are selling 22% over CV.
Is that an average?
That's an average, yes.
Yeah, but this is I think that the deeper the question is that what I'm saying in relation to these different sales properties, are they similar in the same area, right? So there may be some that are higher, maybe some that are lower.
Yeah.
So if you average that out, that's all you're going to get.
Yeah, there are regions, right? So if you look at Auckland, just for an example, like over the last 12 months, properties are sold at -9 over CV, so 9% below CVs. Now, that could have been because of when the last CVs were done, and I believe that was in 2021 or 22, where property prices were obviously a lot higher. And now we're in the market that we are, so they've come down. So they're taking the average over the last 12 months because we should be due for another CV soon, but you got to say something.
Yeah, what I'm saying is that let's just say a market, Auckland, is made up of two properties. One's 10% under CV sold, one's 10% over CV sold.
Yeah.
So what's the average? Zero, right? So that's not a very good... You see what I mean?
Yeah.
Like, why did this property sell for 100K or 10% over at CV,
Yeah.
and why did this one sell 10% under?
Yeah.
And why is the value of a property, aka how much someone is willing to pay, so uncorrelated
Yeah.
to council valuation?
Yeah.
That's the question I want answered.
And
I've never really heard anything. And I've looked at ones like, because of the land value. And then I look at this one, I'm like, oh no, that's got the same amount of land. So I've never really seen it. And I've never really crunched the numbers. So I
guess
know.
in that aspect, because we don't really go off council valuations anyway, it's all about the registered valuation, right? Because that is ultimately
sale price is the gold.
Yeah.
Right. RVs are great. You know, at least it's semi-science based, but they are people at the end of the day doing these reports. So that's why you get a difference in opinion. But I think the biggest thing is like what a property is worth is what someone's willing to pay for it.
Yeah.
And that's what the market is. It's a true price indication, right? And so I think it's very loosely correlated.
Yeah.
But what it does do is it affects how much rates you pay.
Yeah.
But I think it's also the way the council does it is there's probably an increase metric. Like it's like, oh, it was this 4 years ago or 3 years ago, whatever it was. And then we'll increase it by this amount. And there's probably something tying to land value as well. So, yeah.
Yeah, and sales value. Yeah, but
Tell
I guess
us how it works.
but I guess that's the thing, right? If we do have anyone that can explicitly explain how that works, would love to know a little bit more there.
Someone will write a paragraph comment in the section and let us know exactly how it goes. So thank you for that person in advance.
In advance. And I guess the key thing here is, talking to real estate agents if you're looking to purchase, right? Only once you understand what you can borrow and all of that. We've talked about that many, many times. Looking at sales prices will give you a bit of an indication inside that area that you're looking for as to similar properties, what they've sold for now or a couple of months ago or even a year ago. You can get that data relatively easy, right? Now, talking about the sale prices, and one thing that could affect that is the OCR, right? Potentially. It's more of a market shift. Now, the OCR, the official cash rate, is set at what, 5% right now? 5 basis points?
What is it?
But either way, there's talks in November of maybe this stays the same, maybe it goes down a little bit. Now, we're not economists, so we don't know, but I want to talk about what you think could happen. If it stays the same, what might that mean? But if it does reduce, how does that affect the market?
I think people have expectations, and if you have a look at like the bank economists and some of the prominent economists, they're making predictions. And so when things happen differently to the norm and what they're predicting, that's when people have to readjust a whole new view on where things are going, right? And so I think that it's going to remain unchanged. I don't think it's going to be until maybe early to mid next year before we actually have any changes. And I think that we're going to have to go through some big pain. And most importantly, I think domestic inflation is going to have to come down before the OCR is reduced. That's their target, right? That's what they're there to do. And why are they reducing interest rate, the OCR, if inflation isn't under control?
I guess the only reason they would is because they believe it is, right?
They would have to have the stats to show that. So yeah, I think it is going to be some time, and that's purely down to the fact of you have a look at domestic inflation. It's so sticky.
So let's say you're wrong and it does go down 0.25. Well, how do you think that's going to shape the market?
I think it's going to be. I don't think there's going to be anything good. I think there's no real fundamentals in my opinion to really start the big market cycle again. So you may have a secondary dead cat bounce type of thing if that happens, which essentially is like values may go up in a short period of time,
rates
but not
will go
sustain.
down.
I think rates are going to come down.
Well,
so this is a different discussion. Like, I think the banks will reduce interest rates before the end of the year without the OCR needing to come down. I mean, we saw this. We saw the OCR not move and we saw rates go up. I think it's going to be the same thing. So rates will come down. And the reason being is because the margins the banks are making have been recovered. And so the competitiveness going into summer will probably be on the forefront of the minds of the banks. So I think that's what will drive it, along with if everything stays steady in terms of overseas funding. That's going to pull it down.
Yeah. Because if we do get a reduction, we are probably going to see an immediate reduction in rates potentially. That, as you said, that's going to happen anyway, right? But people who are coming up maybe for refixes shouldn't be expecting massive changes, right? It's fair to say November or holding out. Now the advice has always been the same when it comes to when you do go through those restructures. It's about your goals, your objectives, it's about your security, all of that. So holding out for this might happen isn't really the best approach, right? It's about getting the right advice, and whether you split your loan up into multiple segments at different intervals at 6 months, 12 months, 18, 24, whatever that advice is by that advisor that gives it to you. But what we're more or less seeing is that shouldn't stop people holding off. It should also not influence people's decision too much at this point in time, right? Because there's a lot of changes that have been made as well, right? Like we've gone through a list of them today that are going to affect the market in so many different ways. One of them being the OCR, potential changes, isn't the one that's going to drive it ridiculously fast or ridiculously slow, right? It's fair to say. Now, it would be interesting to understand what people listening or watching, what they think. Do they think it's going to stay the exact same? Do they think it's going to go up or down? The reality of it is I don't think anybody knows that answer yet. It's in November. It's still a long way away.
Well, I think it's unchanged. What do you think?
I'm probably going to side with you on that as well.
Oh, that's boring.
I know. Could have had a bet. I think my thought process is very similar to yours. Plus, I've also heard multiple people say the exact differing things in the same, when your jobs are, like an economist, and each economist is saying different things. It's quite hard to actually figure it out, but I'm not the one making that decision. I know it's not going to change the advice we as a firm is going to give, and that's all that matters for me. I don't ever focus on the things I can't control, right? I can only ever focus on the things that I can control, and that's one thing I can't. But the one bit of advice, I guess, is go and talk to somebody, an expert who knows what they're doing. Take a look at the structures that you're on. Are they suitable? Are they not? What can change? How to influence it? All of that aspect of things. But yeah, I don't think it's going to change. In the comments below, would love to hear what your thoughts are. Also, if there's anything that you'd like to add on the comments in which we've had or the discussion that we've had, would definitely encourage that you do so. You wanted to do a little giveaway, didn't you?
Yeah, I think put your money where your mouth is. I was going to make a bet against you, but maybe you can give the bet out to anyone else who...
Well, we don't have November. We've got a long way to wait till November. So how about this? We'll put a $50 Prezi card up or something like that, right? For somebody in the comments below, whether it's a positive, negative, informative comment below just about the podcast today, what they think the OCR is going to do, how they might think the bright line test might change the market. Love to hear some thoughts in general. And you never know, there could be a few points that get brought up in these comments that we thought, we might speak about that in a little bit more detail. Might even ask for your number, give you a call and say, hey, let's go through this live. Who knows? But as always, it's been a pleasure to have you on. It's getting very close to calling you my co-host. Very, very close to that. I've had you on so many times. But the next podcast I actually want to run through is like the ultimate checklist for first home buyers, or just buyers in general. Right? Who are the people that you need in your corner early? Who are the people that you're going to have to call on? We're going to talk like builders, lawyers, accountants, advisors, all of that, to set yourself up for success, and don't just stumble your way through a pretty stressful but also enjoyable process. So until then, I'll let you go back to your clients, go and do what you need to do. And I appreciate everyone listening. If you have made it this far, thank you once again. And yeah, see you in the next one. Cheers.